Alrighty, so let's deal with one of the most fundamental variables in macroeconomics, gross domestic product, or GDP. From the term, you can probably figure out what this is going to be referring to. Gross means total. Domestic means in the context of a nation, domestic means within the borders, and product here refers to production or output. So gross domestic product, translated, means the total amount of output produced within a nation. Now there's two types or two measures of GDP. One is nominal GDP. This refers to the total market value of all final goods and services produced in an economy at a specified period of time at current prices. So whatever the prices happen to be, take the final goods and services that are produced multiplied by their prices, gives you their total market value. You add up the total market value of all those final goods and services, and that will give you nominal GDP. Now, for a specified period of time, because obviously it can't be forever, the total amount of goods and services produced for all time until the universe ends, it's for some specified period of time, usually a year, but it doesn't have to be. It could be 3 months, it could be 4 months, it could be 6 months, it could be 2 years. Normally we think in terms of a year. How is it measured? Well, we can measure it in two ways. We can measure it either by looking at the total amount of expenditure on the goods and services, that'll give you a certain amount of money spent, or you can think about it in terms of, measure it in terms of the income generated by the sale of those goods and services. Technically, they should end up being the same amount of money because the income generated by the sale of the final goods and services must have come from the expenditure on those final goods and services. If you spent $5 buying a pencil from me, then I have income of $5. So we can measure this nominal GDP either by the total expenditure on the goods and services or the income generated by producing and selling those goods and services. In fact, let's go to the Australian Bureau of Statistics website and see if we can find some data on this. So here we are at the Australian Bureau of Statistics website. All economists love the Australian Bureau of Statistics. It's a very authoritative and very honest organisation. It's just a pity that they are possibly the worst website designers in the history of the planet. Anyway, we need to go to key economic indicators. Click on that. We've got national accounts. That looks useful. No, we don't want that. National accounts. There we are. And Australian System of National Accounts. We want that one. It's got information about that. We want go to the downloads, and we'll download this one here. Australian System of National Accounts. And then we'll see if we can find the information about the measurement of GDP. So, when you download that document and then trawl through it with a fine-tooth comb, you get to page 25, and it has expenditure on GDP current prices. So this is nominal GDP, GDP at current prices, and it's the expenditure method of measuring it. So we're taking the total amount of expenditure in the economy on final goods and services produced. So let's look at 2013, 2012, 2013. We've got our categories here. There's final consumption expenditure, which is made up of government expenditure and household expenditure. And as we look down there, we can see that it's, so that's huge. So this is millions. So it's so that's 1,100,000, 110,000 million, or in other words, $1.1 trillion in total consumption expenditure. Right, next one is private gross fixed capital formation. Now that is statistical talk for investment expenditure. It's expenditure on the building of dwellings, non-dwelling construction, the purchase of new machinery and equipment, cultivated biological resources, intellectual property products, and that gives you your total. So that comes to $358 billion in investment expenditure. Private investment expenditure, that is. And the next expenditure category is public. This is government investment expenditure by corporations and the government in general, including state and local. So the total investment expenditure by the government sector comes to 70 billion. You can see the private sector investment is substantially larger. Then it gives you the total gross fixed capital formation, so the total amount of investment, private and public. And we've got inventories. Inventories here is referring to kind of like warehousing, so the production of goods and services which are then stored. We can see total comes to 2 billion. Alright, so then we go to the end. Gross domestic product. 1.5 trillion dollars is our gross domestic product nominally. Alright, so that's the expenditure method. If we then keep scrolling down, we could look at the income method of calculating nominal GDP. So this is income from GDP at current prices. So this should be roughly the same. So if we divide up, because it's the expenditure is income for someone else, so we can divide up that into compensation for employees. So this is for workers, wages and salaries, employee contributions, so that's things like superannuation. Then we've got gross operating surplus, and that boils down to profit. This is income for businesses. So there's the non-financial corporations, the financial corporations, and government, rent from owning dwellings. We've got gross mixed income. I don't actually know what gross mixed income is. I have to look it up in the statistical definitions. Anyway, so we add them all up and we get total factor income. Add to that taxes, less subsidies. So why the taxes are included there? Because that's income which has been siphoned off as tax, so it's technically still income. It's now gone to the government. And anyway, when you add them all up, we come to gross domestic product of $1.5 trillion, just like with the expenditure method. Incidentally, let's just quickly have a look at the difference between, this is for 2012-13. That's wages and salaries in total, compensation, and total gross operating surplus. Yep. So you can see that there's the amount of the total income going to, you could say, working families and so on, is $740 billion, and the income or profits going to corporations, ultimately to shareholders in the form of dividends, comes to about $500 billion. Okie dokie. That's that for nominal GDP. Now let's talk about the other kind, the other category, real GDP. This is the measure of GDP that economists are most interested in. It's the total market value of final goods and services produced in an economy in some given period of time, usually, yeah. And here's the catch: holding prices constant, or sometimes referred to at constant prices. So, or GDP deflated. So here what we're interested in is, with nominal GDP, the reason that the GDP can rise is because the actual number of goods and services produced in the economy could get larger, but also the prices of the goods and services sold in the economy could also increase. Now, economists will want to ask the question: yes, we know that nominal GDP can increase because prices and output is rising, but how much is just output by itself rising? Now you could say, well, the way you can check whether how much output is rising is by going around and collecting data on the physical production of all the goods and services in the economy. To which economists reply, bugger that takes too much work. There's an easier way of doing it. And the easier way of doing it is that you take the statistical information that you have about nominal GDP, and then you take the information that you can collect fairly easily about the general price level within the economy as a whole, and you pretend that after some year, you pretend that the prices don't change, and you recalculate GDP, the market value of the final goods and services, based on the prices from a fixed year. So you say, okay, let's fix the prices we'll set prices at the prices from 2005. And let's pretend those prices never changed. So we'll use 2005 prices from now on in calculating GDP. So, if GDP goes up from now on, what's causing it? What's causing GDP to go up now? Is it prices? No, because now we're using 2005 prices and we're not changing them. The only reason GDP would measurably rise from now on is because output has gone up, which is what economists are particularly interested in. So here's how we can calculate it in a very simple way. Real GDP equals 100. It's the base year, divided by the price index for the year that we're interested in, say it's 2013, the price index in 2013, times nominal GDP for 2013. So we've got the nominal GDP for 2013. We use the income method or the expenditure method. We've seen the Bureau of Statistics can easily collect that data. And then you use the price index for 2013. So if you say, I'm going to set prices at index prices to 100, I'm going to say prices are set at 100 in 2005, and every year after that, if prices go up, the price index will go up to measure that. So for example, in 2006, if the price index is 105, up from 100, we know that prices have increased by 5%. Yeah? So let's do a little calculation. Let's say the nominal GDP is $900 billion. The price index is set at 100 in 2005, say. And let's say by 2013, the price index is now 110. Which we can rewrite as 0.9. So 0.9 times 900 billion gives you 818 billion. So what we're saying is that if prices hadn't gone up from 2005, then GDP, as we normally measure it, would have been $818 billion. Or, expressing it in a different way, the GDP that is now being generated for this year is worth $818 billion at 2005 prices. Alright, what does GDP intentionally exclude? It doesn't count all spending in the entire economy. Here's what it excludes. It excludes spending on or income from the following. Second-hand goods. Obviously, second-hand goods, spending on second-hand goods or income earned from selling second-hand goods, obviously is going to be excluded from the GDP calculations. Why? Because second-hand goods were not produced originally. The second-hand goods were not produced in the year in question. Second-hand goods might have been produced in 1965. We don't want to count them as being produced this year. Intermediate goods, that is, the inputs used in the production of a final good which is sold this year. For example, if we count the market value of iron bars that are sold this year in the Australian economy. Let's say that's the final product, iron bars. So we count that as part of GDP. What we don't count as part of GDP is the value of the iron ore independently of the iron bars. The iron ore was used to make the iron bars. Say one iron bar is produced and its market value was $1,000, that's counted as part of GDP. The market value of the iron ore which was used to produce the iron bar was, say, $600. Now that value, that $600 worth of iron ore, is already included in the market value of the iron bar. So if we count the value of the iron bar, we're already counting the value of the iron ore. We don't count each one separately. That would be double counting. We don't include pure financial transactions, such as gifts, the purchase of stocks or bonds, because these are not representing goods or services which have been produced in the economy in the year that we're interested in. Government transfer payments, such as the age pension or unemployment benefits, are not counted as income from GDP. It's obviously income of some kind, but it's not income that counts towards GDP. Why? Because it's not money that's earned due to the production of goods and services. The age pension is not given because the elderly have been producing goods and services which they sell. They get the age pension simply because they're old and they would die or have to eat their cats or something like that if they didn't have that. And imports. We don't count imports as import expenditure or import spending as part of GDP for the pretty obvious reason that imports are not produced within the Australian economy. Remember, it's gross domestic product. It's not gross domestic and international products. So we exclude spending on imports.